Nothing looks broken. The houses still stand. The streets are still clean. Lawns are trimmed, mailboxes upright, driveways empty during work hours. From the outside, the American housing market appears calm, almost boring. There are no foreclosure signs taped to doors, no frantic sellers, no collapsing prices flashing red across financial news screens. And that's exactly why most people are missing what's happening. Because the American housing market is not crashing. It is freezing. Sales are slowing, movement is vanishing, buyers are pulling back, sellers are refusing to budge, builders are hesitating, investors are quietly exiting. The system still exists, but it is barely moving. And history shows that when housing stops moving, something big is about to change. This is the story of how America's housing market reached this moment, why the data looks deceptively calm, and how a quiet shift is already reshaping the future of affordability, wealth, and economic mobility, long before most people realize it. Housing is unlike any other market. Stocks reprice every second, bonds react instantly to interest rates, but homes move slowly. They trade infrequently. And when they stop trading, prices can appear stable even as the foundation underneath begins to crack. That is what the current data is showing. Home prices on paper look resilient. In many cities, prices are flat or slightly higher than a year ago. Headlines still talk about strong demand and limited supply. But underneath those headlines, a critical metric is collapsing. Sales volume. The number of existing homes being sold has dropped to levels not seen since the worst moments of the 2008 financial crisis. In some regions, transaction activity is even lower, despite a much larger population. This disconnect matters. A market where prices hold but volume collapses is not healthy. It is stuck. And stuck markets don't stay stuck forever. To understand this moment, you have to go back to the pandemic years. Between 2020 and 2021, mortgage rates fell to the lowest levels in modern American history. 30-year fixed rates dropped below 4%. Millions locked in loans at 3% or less. This wasn't temporary stimulus. These were long-term fixed contracts, essentially lifetime financial assets. Then inflation surged. The Federal Reserve responded by raising interest rates at the fastest pace in decades. Mortgage rates doubled. In some moments, they nearly tripled from their pandemic lows. In past cycles, this would have triggered a wave of selling. This time it didn't. Instead, homeowners stayed exactly where they were. Why would anyone sell a house financed at 3% to buy another one financed at 7%? Why trade a stable, affordable payment for one that could be thousands of dollars more every month? For most households, selling became financially irrational. This created what economists now call the rate lock-in effect. Millions of Americans are not moving, not because they are struggling, but because moving would permanently damage their finances. And when homeowners don't move, the entire housing system begins to seize up. One of the most misunderstood aspects of today's housing market is inventory. Low inventory is often framed as a sign of strong demand, but that's not what's happening. Inventory is low because supply has been intentionally withheld. Homeowners are choosing not to list, not because they don't want to sell, but because selling means losing their low-rate mortgage forever. This is a crucial difference. In 2008, inventory surged because people had to sell. Foreclosures flooded the market. Prices collapsed quickly. Today, inventory is suppressed because people refuse to sell. This creates an artificial sense of strength. Prices don't fall because there are fewer transactions, but fewer transactions don't mean healthy demand, they mean paralysis. And paralysis creates pressure elsewhere. If existing homeowners won't sell, who is left to buy? In theory, first-time buyers. In reality, they are disappearing. Higher mortgage rates dramatically change affordability. Even if home prices stay flat, monthly payments explode when rates double. A house that was barely affordable at 3% becomes unreachable at 7%. Down payments grow, debt-to-income ratios break, student loans resurface as a major barrier, rent continues to consume income, making it harder to save. As a result, many young households are delaying homeownership or giving up on it entirely. This is not just a housing issue. It is a generational wealth issue. Homeownership has long been the primary way middle-class Americans build wealth. When access to that system narrows, inequality widens, quietly and structurally. And this shift doesn't show up immediately in price charts. It shows up years later in who owns assets and who never gets the chance. The question everyone asks is simple: is this another 2008? The answer is no. And that's precisely why this moment is more confusing. The housing system today is fundamentally stronger than it was before the financial crisis. Lending standards are tighter. Most homeowners have significant equity. Delinquencies remain low. There is no forced selling wave. But strength at the balance sheet level does not guarantee a functional market. Instead of collapse, the market has entered a state of behavioral deadlock. Sellers are anchored to peak prices. Buyers are anchored to low-rate affordability from years ago. Neither side wants to move first. So they wait. And waiting becomes the dominant strategy. Home builders often provide early signals of where the market is heading. Right now, their behavior is cautious. New construction has not collapsed, but momentum has slowed. Builders are not aggressively cutting prices. Instead, they are offering incentives. Mortgage rate buydowns, closing cost assistance, quiet concessions. These tactics matter. Price cuts reset expectations. Incentives do not. Builders are trying to preserve price levels while still moving inventory. That tells you they are uncertain, not confident. They are preparing for a market that could turn quickly, but not betting on an immediate collapse. This kind of hedging usually appears before a broader shift. One of the least discussed consequences of the current freeze is the collapse in mobility. Americans are not moving like they used to. They are not relocating for jobs, not downsizing, not upsizing, not migrating between regions at historical rates. Housing has become a barrier instead of a bridge. This affects labor markets. It affects productivity. It deepens regional inequality. It slows economic dynamism. A workforce that cannot move is a workforce that cannot adapt. And the longer this persists, the greater the economic cost becomes. During the pandemic boom, investors played a major role in housing demand. Low rates, rising prices, and cheap leverage made housing attractive as an asset. That equation has changed. Higher borrowing costs reduce returns. Rent growth has slowed. Regulatory pressure has increased in some regions. As a result, institutional and small investors alike are becoming more selective or exiting entirely. This doesn't cause an immediate crash, but it removes a layer of demand that once supported prices at the margin. And in thin markets, marginal buyers matter. Many people expect higher rates to automatically cause prices to fall. But housing doesn't work that way. Prices fall when sellers are forced to sell. Right now, sellers are not forced. They have low payments, high equity, stable jobs. So instead of cutting prices, they withdraw listings. This keeps prices elevated, but at the cost of liquidity. Eventually, something has to give. Either rates fall, or prices adjust, or incomes rise dramatically, or external pressure like recession forces movement. The current configuration cannot persist indefinitely. Turning points are rarely dramatic. They don't arrive with sirens or headlines. They arrive as subtle shifts in behavior. Fewer listings, longer days on market, more incentives, fewer first-time buyers, less movement. The American housing market is not balanced. It is paused, and pauses do not last forever. When movement returns, it will not return evenly. Some regions will adjust faster than others. Some homeowners will gain flexibility. Others will face pressure. What looks stable today is actually fragile in a different way. Not because of debt, but because of immobility. The greatest risk in this housing cycle is misunderstanding it. People see stable prices and assume safety. They see low inventory and assume strength. But a market held together by refusal to participate is not resilient. It is tense, and tension eventually resolves. The American housing market is quietly turning, not in a single direction, but away from the old rules entirely. What comes next will not look like the past. And by the time it becomes obvious, the opportunity to prepare will already be gone.